The information in this episode is current as of the date recorded and is not intended as financial, tax, or legal advice. You should consult your tax, financial, and/or legal advisors before implementing any transactions and/or strategies concerning your finances. And with that, let's get to this week's episode.
Hi, I'm Jason Nickerson, President and COO, and this is Financial Focus. On this week's episode, the Federal Reserve did not raise rates this week, so what does that mean for you? On Wednesday, June 14th, the Federal Reserve met and decided to not raise interest rates, as what somewhat was expected, certainly. This comes after 10 consecutive rate increases since March of 2022, where rates were near zero and are now over 5%. So the question on many people's minds is, are we done with rate increases? Probably not. If you listen to the meeting or review the meeting notes, it was also hinted by Fed Chairman Powell that there could be 2 more rate increases this year. So it appears to be just a pause and not a change in overall strategy. You see, the rate increases have to take time to impact the economy. Increases in rates are near immediate, and those impacts on the economy take time to be seen. So inflation is showing signs of having hit its peak, but we probably need a little more time to see the overall impact on the Fed's strategy to curb inflation by raising rates. So what should we do now? Well, the Fed has not signaled lowering rates, which would cause us to consider lengthening our bond and CD maturities. That would signal a peak in interest rates. Also, we still have an inverted yield curve, which says that we can still earn more by staying shorter term than we are in longer term bonds. In addition, there's still so much conflicting information out there, it's really hard to say directionally where we're headed. The market has recovered significantly from lows. There's still lingering expectations of recession. The Fed has signaled more rate increases. And if the Fed pivoted in their strategy and began to lower rates, that may not be a good sign for the economy. We may just have to pause, just like the Fed is doing, to give more consideration to any changes in our own personal investment strategy. So in the meantime, rates on fixed income strategies are much higher than they have been in recent years, and there are many ways to take advantage of that, as we've discussed. Thank you for joining this week's episode of Financial Focus. We'll see you next week.